Hello, hello, hello. Welcome now, Stock Trades. All right, my apologies, guys. This is deja vu. It's deja vu all over again. So I went ahead and made this video. I made a live. It was really long because I was doing the calculation. And because of it was so being long, I went ahead and I stumped up on one of the options return on investment calculation. So I'm redoing the video because, again, I like to strive to be as most accurate as possible to my frontal lobe's capacity. So I don't think YouTube is going to hit notifications on this because I think it's 3 videos or something like that they do. I'm not really too sure, but so my apologies for the confusion. So what we're going to do right now is we're going to do an intrinsic value on SoFi. We're going to look at the value. I've already done this, so it's going to be a lot faster than how I did it before, which sucks because you will see the process of how long it takes to calculate a value, but I'll explain it regardless. Then we're going to look at the options chain to see how we can print cash, right? Again, nothing I say is financial advice. Take it as a grain of salt for what it's worth. What I do want to do is I want to open up SoFi here on the want to open up SoFi real quick and take a look at the technicals here. So overall, you can see SoFi's below its 200-day right now on the day and the hour. It's been kind of going oscillating back and forth. We were headed towards a great direction, but then it broke out of this, and then we're trying to reestablish. We're actually in a downward channel right now, right? We're trying to reestablish. So from technicals, it looks almost ready to. Again, the RSI looks pretty over sold here. So we're looking to hopefully see a rally come this week, given in our past videos that we talked about. So from the fundamental analysis, we're going to do the normal way of how we do an intrinsic value multiplied by 5%. And then you're going to see the conundrum on where we were placing ourselves in regards to SoFi. So we're going to go here. So we're going to go ahead and take the revenue, multiply by 5% to estimate future free cash flow, which you'll see it's actually negative, but you have to estimate it. Another thing that we're going to do, and I'm going to do this first, we're going to open up the help menu for the stock terminal. This is part of our stock terminal. If you guys want access to it, we have a $1,000 off coupon. Thank you to all the people that have joined. Can't wait to work with you in this wonderful community. We're going to go ahead and do SoFi here. And from this angle, we're going to go ahead and get the financial sheet data. And that's going to download directly to our computer. We're going to go ahead and look at the complete quarterly financial results of SoFi. I'm going to actually just focus our attention on one key element here in the statement of cash flows. I just want us to basically focus on these numbers. SoFi has been profitable. They have been positive. So whoever tells you SoFi is not profitable, they're wrong. I don't think no one's saying that, but I'm sure there people are out there. We can always just look here, and we could look at the cash flow and look at the net income. Well, that's weird. This doesn't say it. I guess we'll just Yahoo Finance. What trash are you? Seriously. Let's go ahead and expand. There. So you can see on the net income, you can see they're positive. I'm not too sure where you can see the EPS on here. Again, I don't really use Yahoo Finance a lot. So what I wanted to show you guys, let's collapse, is I want to show you the free cash flow. We don't care about the trailing 12 months. All we care about is March and June, Q1, Q2. For Q1, they had $704 million in free cash flow. For Q2, they had negative $523 million. So if you subtract, so we'll do this again, subtract 704 from 523, you get $181 million in free cash flow. That's the positive. Right now, SoFi is positive 181 free cash flow in the fiscal year. Now, what are we going to see Q3 or Q4? I'm not too sure. Last year, they were heavily in the negative. But if you compare, of course, it doesn't give it to you. If you compare SoFi now, I mean, it potentially could go all the way negative. So, but if we were to extrapolate this and we say, you know what, as of now, it's 181, we can create some form of an intrinsic value calculation. Okay. So I'll tell you kind of why it's difficult for me to do. But the first step into looking at any company is to see kind of what could be the value. So you do 2396, that's the revenue. So 2396, we're going to multiply it by 5%, right? 0.05. That's going to estimate our future free cash flows, which is conservative. We're going to divide by the number of outstanding shares, which is 1059. Okay. Well, hello, 1059. And then the growth rate, we can use this one for now, which is 20.93, right? It'll just round it up, but 2093. So we put 2093. We'll go 10 years into the future and discount back, and we're going to use the 1119 that we calculated. By doing this, you only get $5.70 as the bull case. How you doing, Patrick? Hello, hello, hello. So you only get $5.70 as the bull case. Okay. Now, obviously, that's not what we expected because it's trading above its bull case. Okay. So the question we have to ask ourselves is, okay, well, hold on for a sec. All right, sorry about that. So again, it's either the revenue growth rate is low, or sorry, it's either revenue the growth rate is wrong or the free cash flow is wrong. Obviously, if you look at Wall Street actually thinks the revenue is going to go down in the coming years. Now so if I could throw us a curveball and say no, but they're estimating 15%. So it's actually lower than what we're growing at right now, which is 21%. So we got to figure something out, and we did, remember? So we're going to just change this to 15, like I said, but we're going to go back to the financials here, into the cash flow, and I just want to just take a look at these two central components here. We're going to look at a quarter. If we were to add 704 subtracted from 523, you get 181. We did that earlier, okay? So now I'm going to go ahead and I'm going to grow this at 15%, and I'm going to grow this at 181. By doing that, you go ahead and you get 560, which is still low because we went ahead and decreased our revenue growth rate. You do 21, then it goes up to 865, but we're going to do 15. The problem is you're basically taking 2 quarters of free cash flow. You're taking 2 quarters of free cash flow, and you're assuming that the whole year is going to be 181, which is extremely conservative. So how are we going to be able to get to the actual free cash flow? So we go ahead and we have to add up the revenues from Q1 to Q2. So we go to income statement and we go to hit quarterlies, and we add 585 to 598. Okay. So we do, I'll just go right here. 585 plus 598. So that should give you 1183. So you go here, you type in 1183. So this is the revenue for Q1 and Q2. Then we're going to do 0.05%, and we're going to equal it and multiply it out. And we're going to estimate the future free cash flows of 5%. We know that the future free cash flows is 181. So now we want to get this number, this 59.15, equal to 181. In order to do that, we have to change the percentage. Do you think we have to increase it or decrease it? Obviously, we have to increase it. So we'll try 10%. That'll get us to 118. We'll try 12%. That'll get us to 141. We'll try 13%. Okay. 153. We'll try 14%. 165. We'll try 15%. 177. If we try 16%, 189 too high. So we'll do 15%. So we know that from the 2 quarters of SoFi, we were able to generate 15% of the revenue to get the free cash flow, which was 181. How did we figure it was 181? Because we went ahead and did simple math that we learned in elementary school, and we went ahead and took 704, subtracted from 523, we got 181, and that was for the 2 quarters. Then we took the revenue of those 2 quarters and multiplied them until it equaled 181, which is 15%. So now we're going to go back to this one, and we're going to multiply it by 15%. This is for the full year, because the revenue is around 2.3 billion so far. By doing that, you get a free cash flow of 359 million, 0.4. So you go upstairs here to the average free cash flow, and you type in 359.4. And by doing that, you get a price of a bear of $6, 606 to be specific, which is right in line to the 52-week low. And the bull case, which is $11.12, which if you go back to SoFi when it was trading here, it was trading at $11.17 on the high, which you can see right there. Okay. So I would say this is an accurate representation. Again, not financial advice, just from an educational perspective, I would say. But this could be the free cash flow. But now the next question arises: what are the holes of these assumptions? The hole could be the negative. I'm poking holes in my assumptions. What happens if next quarter they turn up another negative free cash flow, and they're not positive like the one in Q1? So we have to learn why they were positive in Q1, right? So you have to go to the stock terminal, look at the earnings transcripts, and look at that, right? The next question is what happens if Q4 ends up being negative? So you have Q3 and Q4. What happens if they, September and December? What happens if they become negative? Well, then, we could potentially see lower stock. We could, it depends, because why it's negative, I think they're investing. Another thing you want to look at is its EPS, which if you were to look at it, it's actually positive because they're profitable now, which you can see here. Their actual was 0.1, then it's 0.02, then here's 0.02, and here we're expecting 0.04. So that's what the estimates are expecting. So they're expecting a pretty good number for Q3. So hopefully they beat, and then it's free cash flow positive. But if we could see that, then we could go ahead and do that. So a great way to also is just, you could do a 25% discount rate, and that'll get you to $2.86. So you can see, like, there really isn't a margin of safety here, right? And the reason why there isn't is, it doesn't take, it doesn't take someone who's a genius to figure this out. But if you look at the overall assets of SoFi, and divided by 1,000, they got about, am I reading this correctly? They got around, I don't have to read anything. I can just go here. They have around, what does that say? What is that? $2.7 billion from this particular asset. I wouldn't be reflective of these numbers, but I hate how these numbers are in thousands. My brain can't read that. So let me just go ahead and go to our stock terminal real quick. I don't like to read. I like to read in millions. This number is in thousands. Can you please translate it into millions? So yeah, 30 million, which is So stupid. I don't think that the assets are 30 million. That's ridiculous. I think it's 30 billion, which doesn't make sense on my end. Hold on. So there's one thing I don't like about Yahoo Finance. It's like, why put it in thousands? Am I missing something here? Hold on. Yeah. Yeah, like I said, so it's 2.5 billion. So our platform is correct. This is I don't know what the hell this is. Let me take a look at here. Yeah, 2.3, 2.5 billion, and it's been increasing ever since. So if you go ahead and take a look at it, it SoFi is not. If you look at the total assets, and I got to make sure I'm not reading this incorrectly, but I believe their total assets is $32 billion. Yeah. So that's in the 30 range. I don't know why they're saying this in thousands. I don't. If you have something, so this is why Yahoo's shit. If you have a company in the billions, why are you saying the numbers in thousands? I mean, are you just trying to confuse real retail investors? Like, why are you saying thousands? Who the hell operates in thousands in a $1 billion company? The most stupid freaking platform ever. So that's why SoFi 7 billion. It's not going to go down to $2. I'll be remiss. Its book value is $5.57, right? So, so I doubt there's going to be a 25% discount rate. There's just no way. I have them growing at 15%, but if they continue, let's say they do 21%, then we could see higher prices. But I'm going to do 15%. That's why when the stock was trading at 28, I was actually a bear. And even 22, I was like, no, this is too expensive. And everyone was like, no, you're wrong. And then everyone who was a SoFi bull ate crap, right? So I believe there is room in the tank for SoFi to grow. I think we're near the bottom range here. Yeah, here many platforms intentionally obscure the data to avoid pulling it into. No, absolutely, absolutely. I don't understand why they're trying to make it difficult. I mean, I've been in this market for how many years, and I'm like, why are you putting it in? Who the hell reads in thousands? Like, are you serious? Like, what the hell? Anywho, that was really stupid, honestly. Like, why would you put this in thousands? Like, why? I'm gonna see if someone is. Why does Yahoo Finance put their numbers in thousands? Has someone ever like got angry at this? Yeah, maybe something here. It's accounting school uses millions on all documents. Exactly. I mean, that's how when I took accounting and finance, that's what we used, right? We used millions. Who the hell does you use thousands in a small business, okay? Use it in small. I understand for small businesses, but this is freaking SoFi, dude. It's a freaking chartered bank. Anywho, screw you. I'm like, bleh. I'm gonna like puke in my mouth. This is why you go to Owl Stock Trades here, and you go here, and this is in comparison. You don't need it. You don't need accountants before that, right? Exactly. You could just do it yourself. You know what I'm saying? Okay, here's Yahoo Finance. This is what they offer, and this is what we offer. You could tell, like, this is. I mean, I should even be putting their website, their name on my web. It's like such a downgrade, even to put. I just like the name Yahoo. It's just really funny to say. But anywho, SoFi is in the lower end of this. We're not going to see a recession. So that's below book value. This is whoever tells you this is this is going to happen in the great financial crisis, which we're not near. But we're in the lower end because it's trading at $6 and what is it, 64 cents. So we're on the lower end of this. So I'm more inclined to play, right? So I'm happy to play. So now that we determine this, if SoFi, let's say, doesn't do well in its free cash flow and it continues bleeding, well, you could see the book value has been going down. At first it went to 8, then it went to 5, then it went to 554. But you know what? Now it's going up. So I do see some form of stabilization, okay, because they are getting to that profitability, okay? So now that we went ahead and talked about SoFi with this, now let's open up the calculator and now let's talk options, okay? So the reason why I made the video again is because I screwed up on the options, okay? So now let's go in and let's do the options calculation here. And let's say, you know, I want to go in and let's make it easy numbers. Let's do 20,000, okay? 20,000 shares, okay? I'm going to just kind of zoom this in so we can, right? Sorry, you see, I did it again. $20,000, okay? And I want to divide it by how much SoFi costs, which is 664. I'm going to average it, 664. All right, around that. Or let's say 650. I'll have 3,000 shares, but then I want to get contracts. So I'm going to divide it by 100. So I can get around 30 contracts, 30.7, but let's call it 30. We can round up. We'll round up. We'll say 31 contracts. Okay. Well, you know what? Let's just do 30 for the love of God. We'll do 30 contracts. And then we're going to go to August 16 and we're going to sell a put. We're going to do a cash secured put because we're going to collateralize $20,000. Okay. And we're going to go down to $6.50 because we don't care if it hits or not because I want to buy the shares at that price. Okay. I want to buy, right? So on August 16, which is this Friday, right? It's this Friday, right? Good. We're gonna see if we can get them. If not, we'll just keep the premium. Okay. So by doing that, we're gonna put our 30 contracts. We're expected to make $390 in 1 week of premium. If the shares don't get called in, we make $390. If the shares do get called in, we make $390. Okay. So now let's go ahead and let's take $390 divided by 20,000 because we're going to make $390 per week. But let's just focus on what is our rate of return for just 5 days. We're going to divide that by $20,000. We're going to multiply that by 100%. Our rate of return is 1.9%. We're expected to make 1.9% this week. But guess what? We can make $390 every single week, right? So we'll do $390 and we'll multiply that by 4. We can make $1,560 per month using and selling weekly options. Now, if you divide that by 20,000 and then you multiply that by 100%, you make a whopping 7.8% per month. You can easily just calculate it and multiply this by 4 and you would get the same number. Okay. So now 7.8%. So I'm just going to divide this by 4 so we can just get the weekly. So the weekly you make 1.9. Okay. And for folks that are having a hard time following this, we have an educational platform where we teach this along with the data. So, take advantage of the coupon code SAS to get $1,000 off because again, this is the really cool part about options. Okay. But guess what? So 7.8% is made per month. So let's say I do this for a year. What is my rate of return going to be? 93%. So if I make $390 per week, okay, if I make $390 per week and I multiply that by 4, and then I multiply it by 12 months, I can make $18,000, almost $19,000 per year. So I pretty much get my money back and I get those shares for free. Now, let's say what happens if, let's say, week 2 or this week, the shares go down to 640. Uh-oh, you're at 650. So you know what you can do? Now you can sell a covered call. But for this time, you can sell a covered call for next week and there's going to be some depreciation for decay, so it's not going to be this high. It'll probably be the same price as how much you're getting it right now, but we can sell a covered call. Again, 20,000 divided by 650 divided by 100, you get 30 contracts. You put 30 contracts. So then on August 23rd, I can sell a covered call and make $420 in profit while holding my shares, assuming I get called in. So now I'm making 420, right? So you see kind of their you see the magic here. So regardless, let's say I'm selling cash secured puts. Okay, fine. I get called in for that. I own the shares. I'm happy. I want to own the shares because I did the intrinsic value calculation. I know I'm in the bottom end here. Okay. I know there's upside for me, right? Unless they screw things up, which I don't think they will. There's upside. I'm happy. Okay. Because I have 3,000 shares, and let's say I make freaking $6 in SoFi. Well, I just made $18,000 there. Okay. Right. So there's the upside of that. Right. That's if the stock hits $11 or whatever. Okay. So I'm happy holding the share. So let's say I do a cash secured put this Friday. I make my 390. Yay. I make 390. Okay. Off of 20K. Right. And then I get called in. The stock drops to 640. I get called in. I own shares at 650. Okay. I'll tell Mr. Market, I don't care. I'm going to sell a covered call now for the next Friday, or whatever, next week. And then I'll sell it for $7 for a covered call, and I'll make $420. Okay. So you see what I'm trying to say? So let's assume we're making 400. We're making 400 a week now. We're making 400 a week multiplied by 4. So, when I was poor and I was like just 10 years ago, when I had like what 10 years ago? Like 15 years ago, when I had literally nothing. I mean, I'm old, guys. I mean, damn, time goes by fast. You know what I'm saying? God dang. Anywho, it is what it is. You gotta just enjoy the little things, right? So, $400. I mean, think about it. $400 for there it is, TJ the wheel deal. Ladies and gentlemen, if you guys want a real expert about this strategy, you need to go to this guy. So definitely follow this gentleman here. He is a expert at this. So what I just wish I knew this like 15 years ago, right? And the unfortunate part is so let's say, we got, that's why it's important to make sure you have some form of reserves in cash, right? Because 20K is a lot for people. I mean, come on, TJ, right? 20,000 is hard, right? It's hard. Once you get into like let's say, for example, you have $100,000. Okay. You have $100,000 and then you multiply 0.0195. Then you can make 2,000 a week. Then you multiply that out by 4. You make 7,800. Then you're making as much as a starting electrical engineer. You know what I mean? Off of 100K, right? But there's a lot of things you got to kind of understand: intrinsic value, technical analysis, decay, all the fade. You got to understand all these things. But let's just kind of go small. Let's just kind of go small here with the $400 a week. So you're making $400 a week. So you take 400 and divide it by 5 days. You're making $80 a day. Okay. And let's say you are working eight hours a day. So that's about $10. I don't know what the minimum wage is anymore. Minimum wage of Arizona. I don't know. Let me see the minimum wage. It's $14. You see, when I started working, the minimum wage was actually $7.25 when I was a cashier a long time ago. You see, when in Arizona was the minimum wage $7.25. Yeah, you see? Yeah, right here, 2007. Yeah, that's when I was working. Right here. You see, that's a long time ago, guys. Woo-wee. Right? So, yeah, so the minimum wage pretty much doubled. No? Yeah. Wow. Okay. Anywho, um, so just imagine you're making people are literally. I feel so bad. People are slaving. They're slaving just to make 500 a week, 400 a week. They're working 8 hours sometimes, 10 hours just to make a living here, just to be afloat. And here you are sitting in the comfort of your home, and you can do this like this. Unbelievable, right? So there's a lot. There's a lot of comments. I gotta read all. See here. 3/4 of my assets in Clove SoFi. If you don't have as much capital, a PMCC might be ideal. Can give you a similar return with about 8K in capital requirements, but it takes more time to monitor. You see, and that's something you're gonna have to make a video on, because again, TJ is like on the next level for this, right? This is his area, right? For me, I'm a very simple, when it comes to, I don't buy options. The only time I buy options is to close, like for example, if I am doing a cash secured put, and let's say the cash secured put's value ends in November, but then all of a sudden its value just drops down, I'll buy it off for like $300 or whatever it costs, whatever it costs to close it out earlier. That's when I would buy out my own contract, right? That's the only time I buy. When it comes to just other things, I'm very I calculate the value, do the intrinsic value, and kind of do a hold, and then do kind of this Warren Buffett strategy and hedge. But I don't buy. So yeah, that's something that the extent of my good, Patrick, good. So you got a subscriber, TJ. Yeah, TJ is really great for this. Really great man, right? Good. He's a wonderful man. Let me see here. Let me see. What do we do? Let me see here. I gotta make sure I get all your comments. Hello. I'd rather. Oh yeah, I mean, yeah, you got to be careful there, right? Many platforms potentially have. Yeah. Oh, I read these. SoFi. Oh, here it is. Supposed to be lower. Yeah. So this is the thing. You know what I mean? So this is kind of the thing that I'm trying to communicate to folks, because let's say you have 100 grand. Well, there it is. I mean, now you're making 2,000 a week, right? 2,000 a week. And, the question you have to ask yourself is, well, okay, what happens if, SoFi goes to $11, let's say a month from now? Well, then I would be very hesitant to do a, cash secured put at, let's say 10 or something, because we're in the higher end of this, unless they increase their revenue or their free cash flow. So the only time, and this is what takes the, so TJ, this is what takes the wheel strategy to the next level, right? This is where, when you actually understand how much the company's worth, then you don't play the game where the stock goes back up and you're trying to chase it, and all of a sudden you're chasing an overvalue. So when you calculate an intrinsic value graph, when you do like an intrinsic value graph here, you're chasing an overvalued stock, and all of a sudden, you do a cash secured put here, and it gets called in because it's overvalued, because it's way above its intrinsic value. This is where the intrinsic value calculation can really give you that GPS and really help you along with the technical analysis, right? So this is kind of where we're at with that. But you can see the power, right? You can see the power of the math here, right? So we're making, we calculated it here, 1.95% per week. Okay, you multiply it by 4 weeks, which I did somewhere here. I'm gonna have to do it again. You take that, you multiply it by 4, you're making 7.8% per month. Then you multiply that by 12, and again, sadly, these are all be short-term capital gains tax, so it's probably 40% or whatever, right? You have to talk to your tax advisor for that one, right? But again, you make 93.6% per year. The only issue here is, you have a company that's worth $5 million, and let's say, you get called out. Well, you're forced to sell if you're doing a cover call. And if that's the problem, that's a problem, because then then you just created a tax problem for yourself, right? And that's the issue with that. So you have to be okay with that, right? We can just invest in ET for that 8% dividend. No, but here's the thing, Patrick. Here's the thing, Patrick. You see, this is and TJ, please chime in if you're still there. No, Patrick. No, that's wrong. That's wrong. You're wrong. Okay. So here, TJ, you can confirm this here. So, you're right that the dividend yield for Energy Transfer, which is my darlings, I love this company, is 8%. 8.17%. But covered calls and options are tough with this because there's a dividend. People can call you faster for that one, but that's a different story. It's Patrick, this is 8.1%. This is 8% per year. 8% per year. Per year, right? Per year. You're like, right? It's not per quarter, it's per year. So if you go ahead and calculate this and take 8% and divide it by 12 months, you're making 0.66% per month. You divide that by 4 weeks, you're making 0.16%. You see what I'm saying here? You see what I'm saying? So you have to understand, it's all a zero-sum game. There's a reason why the options chain is so juicy for SoFi, right? So you see that, Patrick? You see what you're holding for let's divide that by 12 here. What you're holding for a year of Energy Transfer, you'll be able to get the returns in a month for SoFi. You feel me? Patrick gets it now. You see it now, huh? There it is, right? So again, this will be the third phase of our Mastering Stock Market course, right? Again, this will be the next, the third phase. No, it's fine, man. You don't think I've made this mistake a long time ago? This is the process of learning. If you don't make mistakes, you're not learning, dude. That's how it works, right? We encourage mistakes, just not in your portfolio, right? Just you just do it. That's why I always recommend people paper trade and don't even get in the market until you have some form of some mistakes. You see, now you get it, right? So then now, instead of 8% for the whole year, now what? Let's multiply it for the whole year. We can basically turn this, 93, we can get 93.6% back, right? And that's pretty much your shares for free, right? So here, a major cheat, there it is here. Major cheat code for cash secured puts is to sell one about a year out, take those premiums and buy shares outright and sell calls against your shares. You see, so I'm going to repeat that again because there's some, sometimes it takes. I'm only trying to remember myself when I was like 15 years ago. I wouldn't have been able to understand this. So I'm going to repeat this. I'm going to repeat this again. Okay. So TJ said, major like cheat code is for cash secured puts is to sell one about a year out. Okay. Take those premiums that you get, because you get those premiums immediately. They get deposited into your account immediately. You get them quickly, regardless if the stock goes up or down or sideways or decides to change its pronouns. Doesn't matter. You get the premiums, okay? And then you take those and you buy those shares outright and then sell calls against your shares. That is insanely beautiful, right? Because and guess what, guys? Guess what? You don't think the billionaires do this? They do it all the time. Warren Buffett loves this strategy. Okay, so you'll look up a year later, and it'll be like 25% return. It's insane. Exactly, right? So since we're here, I mean, we're already 6 months out. So I don't know if it's gonna be juicy, but we can do it here. We'll do a sell put, and then we'll do the put for. Let's look at, let me see. Let's do January 17, 2025. It's not a year out. It's not a year out. So, it's funny. There's not even a $6.50, but so we'll just ask Google because I can't do math right now. What's a year out from today? August 11th. So we'll go to August It doesn't go off that. It just goes to June 2020. No. Man, what am I smoking here? It goes to, yeah, there's no August. It just goes to so let's do September 2025. And they don't even have a put for $6, but they have a put for $5. So we'll do a put for $5, and let's just do our 30 shares, right? Our 30 shares was like well, since it's $5, we can probably do more. Let's do 35 contracts. No, 40 contracts. No, 45 contracts. Yeah, maybe 46. Yeah, 46 contracts. So 46 contracts for $5. We're selling a put. We make $3,000. So let's be specific. 29.44. Okay. We divide that out by 20,000. 5.6. The rate of return is 14% return, right? Oh, you're looking at March 25.6. All right, let's look at that. March 2025, right? There it is. March sell a put for 6. There it is. That's a sex. That's way sexy. Okay, there it is. Okay, so let's go ahead and let's do 45 contracts. No. Let's do 20. Let's try to get it close to 20,000. Okay, 39 contracts. It's around there. So March 21, 2025, it pays 77 cents. We go in and we put 3003, and then we go in and we just change this number here. 397. So yeah, you still get around that 14%. Now the thing is with that, I honestly I would argue we just sell the weekly, right? Just sell the weekly puts because it's paying more now. And I think the reason why it's paying more is because of this increased volatility we had with this carryover trade. Maybe it's just a residual effect of the increase in the VIX. I mean, I know the VIX right now has come down, but it could be this spike that's causing aberrations within the short-term weekly calls. Because historically, the longer you wait, it's actually better. That's why I find it so funny. The weekly ones are pretty good, but it pays 70 cents. So yeah. So I mean, I'm looking at it here. So 20,000 for selling a put for March 21, 2025. Right? Am I getting? Yeah. So I got the right one. So, but essentially, what you can do is you take this $3,000 in premium, you buy out the shares, and then you sell covered calls on that, right? So you can hedge both strategies, right? But now let me give you an example now, kind of the situation. So with Clover, I think this thing is going to be $15 to $25 stock, right? And we're going to see that come to fruition in the next 3 to 5 years, right? So let's say someone has 200,000 shares, right? And let's say it goes to 25. That's $5 million, okay? You take that 5 million now, okay? And then you multiply that by 0.0195, right? 1.95%. You can now, with 5 million, make $97,500 a week. Multiply that by 4. You make $390,000 a month. Multiply that by 12. You make $4.6 million a year, right? So I'm just trying to give you an example of what these SoFi's bulls are doing, right? You make $4.6 million a year. This is why, like, the poor always stay poor. You ask a poor person, I give you $1 million, what are you going to do? You know, the poor person tries to be all humble and say, well, I'm going to buy my mom gifts. I'm going to do this. I'm going to buy this and this. It all starts with buying, right? My answer would be, I would buy a cash secured freaking put and I would use the dividends off of that and live off of 20% of that and invest the rest, right? Now look at buying the shares and selling calls against it. And if you sell calls against it, it'll pay more, right? It's essentially a covered strangle to a certain degree. No, yeah, because okay, you remember how we did the math right now, and we got around $3,000 of cash. So let's say we go in and we go sell. When we want to sell a call, TJ, you want to do a year out, or we could do a weekly, right? Well, we'll do. How about this? We'll do the same thing. We'll do the same month, March, and we'll do it for. Let's see here. We can buy the shares outright. Oh yeah. So Mara and Riot, those two, the Bitcoin mining proxies. These are companies that we always look at and we talk about, because these were wonderful companies when they were in the pennies, and then they exploded. They pay insane amount of dividends, insane. And this is where you can use the intrinsic value calculation, calculate the value, and you can make a killing on that, a killing, right? So this is the beauty. And hopefully once I have some opportunity and time, we can have you on and we can actually talk about this, because this is a big cheat code that unfortunately a lot of people are sleeping on, right? And you go in, I'll give an example, because again, I'm not weekly calls. Yeah, exactly. Yeah. So you go to let's you go into Malibu Homes, and you try to fathom, and you try to figure out, like, how can people, I mean, this home is actually ugly. I don't really like this home at all. I mean, it's an ugly ass home. I'm trying to find this one. This proves the point. You walk down Malibu and you walk down California, and you're like, how in the world can people afford an $85 million home? Okay. And you look at this and you are stunned by the amount of wealth people can accrue. So then you try looking for, how is this possible? And then you stumble upon, TJ and all these amazing folks wheeling this strategy. And you realize that, holy shit, that this can be the thing. No, we'll definitely do a podcast soon, 100%. But there is a downside to wheeling. There is a downside. So SPY index covered call. So there's a covered call index where it literally does covered calls. And if you look at it, it's not beating the market, right? So the best time that the wheel strategy works, you can kind of see almost like it's when the market goes down, right? Kind of looking at it here, right? But in my opinion, the best time the wheel strategy works is when the market is sideways. The sideways markets are really nice, because the problem is once you get to that bull market, holding always is better, right? Again, hard to say, because what happens if the intrinsic value is not as high as how much the cover call is going to get, right? So there's a lot of to it, right? But it's always important to know what you're getting into, because what happens, let's say if you do get cashed out, you can always roll your positions and all it gets more, I wouldn't say complicated. It's very self-explanatory, but there's a lot to it, right? So honestly, TJ, and also I need to send you that goddamn book, so I need to get you that book. I'm traveling, so it's been hard. My schedule is going to come back normalizing soon in December. I got to send you that book, and we also have to talk on live or private it's because they don't roll options. Is this why? Okay, this is probably why this shit, because they don't roll options. That's probably why it doesn't make sense. There it is. I want to talk to you about how you can publish your own book, because it'll be nice if you can write a book about this too, right? So we'll go over it. I'm almost home. I can hop in if you like. Yeah, I mean, definitely. I mean, I would love to. But the thing is, I'm on my 50 minutes right now, so I have to get back to it. Do you mind if we do a live? Oh, let's see. Here? Message me. Message me here. Message me here. Support at all stock trades, or message me here. Pick one of these emails. Actually, pick the Al one, but you pick what they all they all end up coming to me. One, my secretary will be able to say, "Hey, message him." Here I monitor every day, and then let's set one up, and then we can go from there. And I think this will be a great live. But I do want to go over TJ with you. I want to go over how I wrote my book, so you can write your own book about this, because I think it's a wonderful strategy, and you're obviously way more experienced than I am at this, right? So straddles are opposite strats for mega millionaires with their boring jobs. Yeah, I mean, yeah. So I mean, it's you walk in these lives of these folks, and you try to figure out, how can someone make $300,000-$400,000 a month? And it may seem a lot, 400. I mean, imagine $400,000 per month, and you multiply that out by 12. That's 4.8 million, right? And let's say divide by 2, because you got to give some to Uncle Sam. You make 2.4 million. Assume 50%, right? Obviously, it's not gonna be that high, right? So we could do that, right? And then you start to say, oh, wow, I can get a private jet. I don't advocate this. And I can get the private jet, because in the private jet I can write off, right? Oh, okay. So, and then you start seeing this lifestyle of these people, right? And you start realizing, how people can afford this type of money, because you start realizing that money just compounds over time. And if you don't understand here, compound interest, Albert Einstein. Absolutely. Now, I definitely would love to help you, man. Absolutely. I'm trying to write a book. I would love to help you. Absolutely. Well, and I also have a software I can just send to you. You can log in and you can use it to help you with the formatting, so you don't have to worry about the format crap. You know what I mean? And that's the thing. I want to create a beautiful community on YouTube. It's just my apologies. I haven't. I've been MIA. It just my lives. It's always alive, because it's always my schedule's erratic. So I want to drive this point. Albert Einstein said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. You know what I mean? So, so imagine if you go in and take your monies that you make from covered calls and cash secured puts. This graph sucks. Let's do this one. This looks more sexier, or this one looks more sexier. Yeah. No, this one. Just simple. This is a nice simple graph. This is it. Sorry guys for the. Imagine you take your nice graph here, huh? And then TJ already knows this. I'm speaking to the choir here for TJ, right? This will be your trajectory, right? This will be the power of this whole compound interest. Okay. Because now you're compounding not only at a compound rate, you're compounding at a high rate. You're compounding 8% every freaking month. Okay. You're compounding 92% per year, right? So you're going to go like this, right? So this is the power of this strategy. But in order to be successful, and in my opinion, again, not financial advice, one must understand the intrinsic value calculation. And TJ, I hope you're following what I did here, right? I took the revenue of Q1 and Q2, and then I looked at the free cash flow of Q1 and Q2, and it turned out to be 181 million. And I took the percentage of that, and it turned out to be 15% of 1.1 billion. And then I went ahead and took that 15% and multiplied by the fiscal trailing 12 months of revenue of 2.3 billion. And then I got 359 million of free cash flow. Now I don't think they're going to be free cash flow positive for Q3, Q4. I could be proven wrong, but at least I think they're going to be profitable. So this kind of gives me an understanding of kind of what SoFi could be, given that it is a high gross margin business. So the Intrinsic's anywhere between 6 and 11. Now, if they somehow increase their revenue, then we can, let's say if they go to 40%, let's just kind of see how sexy this could get. We could see, $64, right? But until then, we're just going to do 15%, which is on the lower end, being very conservative. All right, guys. So anyway, I wanted to remake the video because I screwed up on the premium stuff. So I wanted to make sure I redeem myself there. TJ, it's a pleasure to have you here. Again, for folks that have not, please join his channel. Wonderful gentleman, just wonderful man. Very nice guy. And then we're gonna have to set up a real live, not a thing where you're in the last 50 minutes. I want you from the beginning and end, and we want to put your face on the thumbnail, and we want to kind of put this as a meeting we can schedule, and we'll let because I go to Georgetown, and so I'll know my schedule once I get there, and then once I have a day off, we'll set up a date, and then we can make a live, and we can just talk together, and you can share your screen and you can explain this stuff, because I think people need to hear this, right? I think people really need to learn this, and they need to hear this, and that's it, right? Paying interest is the enemy. No, I mean honestly, so that it really is, and this is why a lot of folks that come to our stock terminal and mastering stock market course, they end up making the money back, right? Given the things we teach and also the data we provide, right? So that's the beautiful part. Warren Buffett said this about investing in yourself. I mean, what was the quote? Warren Buffett, investing in yourself, quote. Generally speaking, this is Warren Buffett, right? Generally speaking, investing in yourself is the best thing you can do. Anything that improves your own talents, nobody can tax it or take it away from you. The best investment you can make is in yourself, right? And that's the whole point of creating this platform, is to invest in oneself, right? The strategy really works well when you find the stock that is slightly undervalued, like SoFi, exactly. TJ is referencing the lower evaluation where we're trading near the bear case here, right? Is a quality stock, right? And we know it's quality. Just look at the assets. They have $32 billion in assets. Screw Yahoo Finance for putting it in thousands in a $1 billion company. Quality stocks right now, because they will hit a year of GAAP profitability next quarter. And that's a big freaking deal. And then TJ's done the fundamental analysis. He's done the hard work. And then now he's comfortable playing the options, doing cash secured puts, and doing covered calls because he's happy to be in the stock. He wants the stock, right? Email sent. Perfect. We'll set it up. Perfect. So this is good. I can't wait. I'm so stoked. Got out. You are just, I don't know, Jesus. No, man, I'm just a man that serves Jesus, right? That's where I'm at, right? But no, perfect, TJ. Now, and here's the thing, TJ. It's so cool how the internet, God bless, and our RIP, the former CEO of Susan YouTube. She just recently passed away. Rest in peace. Because TJ, we would have never met if it wasn't for Susan opening up her garage to the founders of Google. And it's just so amazing how America is, and how giving and tolerable America is, and how we are, so just, I kind of reflect back to these folks and imagine, how many people we're going to help turn millionaires. I think that is by far, what more do you need, right, TJ? Imagine helping all these people. What more could you possibly ask? That's why I went into medicine, right? To help people. And then with this, imagine how many people we can help, right? So this will be good, right? We'll go ahead and set everything up, and there it is. Yeah. And then, that's all I have for you guys. God bless you guys, and I'll see you on the next one.